A massive week for markets, certainly when it comes to the US in particular. The Federal Reserve coming out with their latest monetary policy decision on Wednesday. And then we're wrapping up the week on Friday with the latest core PCE price index data, that Fed's favored inflation metric. All to play for a big week. Will we see a surge in terms of the US dollar and further upside for equity markets, or has the PMI data that we've seen on Monday indicated the possibility of something a little bit different? Let's get into it. So let's check out first and foremost how things look in terms of the calendar. In terms of the Federal Reserve, markets expecting 25 basis point cut on Wednesday, and then on Friday it's the core PCE numbers that are really interesting. And as you can see here, the expectation is that we see a move higher, 2.9 on the year-on-year metric after another 0.3 figure. We'll get into that alongside a host of other different sort of US metrics at the moment, and things that are sort of to be factored in as we lead up into it. First and foremost, it's worthwhile determining exactly why people think we are going to see a rate cut. It wasn't always a given that we were going to see a rate cut in December. We saw shifting sentiment, and now it appears to be essentially dead on that we see a rate cut. Well, part of that come down to the job support that happened at the beginning of this month, the first Friday of the month, of course. And what did we see? Well, we saw better than expected payrolls. We saw an improved figure, so a revision to the prior month. But by and large, if you net out the two, it still comes in at a relatively weak period of time for job creation. Add to that the rebound that we saw, the rise in terms of unemployment, we start to see some fear coming into play. Alongside that, we've seen PMI numbers. So earlier in the month, we saw the ISM services PMI figure, and that came out particularly weak. Now, services has been one of the key determinants and the key drivers of inflation in the US. And certainly, if we see services inflation under control, then it allows for the Federal Reserve to start moving in a more convincing manner. Well, we did see a first indication from that, and now we've just seen the latest headline PMI numbers. Now, we saw weakness in terms of the manufacturing strength, in terms of the services, but crucially, despite the fact that we saw a strong services PMI figure, the prices section of it, the prices segment, told a different story. In actual fact, it was the likes of the services sector, which really eased off in terms of its pace of growth. And that's particularly good news. So that really just nails on the idea that we're likely to see a rate cut from the Federal Reserve, but doesn't necessarily mean that we're going to see a super quick pace of easing. And part of that is down to this idea that we have seen a resurgence in terms of inflation. This is the Trueflation platform, which gives an alternate view on where US inflation is currently running, and they have it at 3%. Now, it's worthwhile bearing in mind that you could see an inflation rate of, let's say, 2.3 or 2.5, right? That may not be where inflation is currently running, because that is a year-on-year figure. And so, maybe inflation was running hot 12 months ago, and now it's cool now. You might actually be running at a pace that's lower than that. That's why I use the annualized figures to be able to tell you exactly what the pace is at the moment. Well, this Trueflation chart highlights not only do they think that inflation's running hotter than headline numbers would state, but crucially, it shows you the resurgence that we've seen over recent months on this chart. And that rebound in terms of inflation expectations does highlight why we've seen the strength in terms of the US dollar, the easing in terms of expectations around what we're going to see from the Federal Reserve in terms of interest rate cuts. So here's the breakdown in terms of core inflation. Of course, we've got the CPI, which is here in blue. We've got the PCE, which is in orange. What's notable in terms of the middle section here, which is the monthly figures, and that's why, I really pay attention to the month on month more so than the year on year. Certainly year on year grabs the headlines. But what's key here is that if you look at the trajectory and the relationship between the month on month for CPI and the PCE, they do, to a large extent, move in relative lockstep. Certainly in terms of the past few months, we have seen strong above target inflation on the monthly side. Remember, we want to stay below 0.2% on the monthly figures. That has not been the case for the last 4 months when it comes to the CPI, and the last 2 months for the PCE, but of course we're waiting for the latest reading there. And then if you look back at the November from last year, that's going to be stripped out. Well, you can see it's 0.091. So that's why we're most likely going to see a rise in terms of year-on-year core PCE inflation. But that comes on Friday. So that's going to come after the Federal Reserve make their decision. But as it stands, the core PCE price index figure, 2.8%. There's a likeliness that we're going to see that moving towards the upside. And the upside that we're seeing for the CPI figure, core CPI at the bottom, you can see here the annualized figure. We're also seeing that in terms of the PCE. So we are seeing a resurgence in terms of price pressures, which essentially is highlighted by those above 0.2 figures on the monthly metrics that we can see in this middle section. So we have seen a resurgence over the last few months, and that's highlighted by exactly what we're seeing here. Those monthly figures are impacting inflation expectations, and that's impacting how people view things in terms of the Federal Reserve. Like I said, it's a services story. The blue line is services inflation. The orange and green lines are essentially goods inflation, one calculated by CPI, one calculated by PCE, but they say essentially the same story, right? Which is goods inflation, by and large, not a problem, and it's pretty much zero, right? Services inflation, that's where the problem is. And certainly the fact that we saw a weak prices paid metric within the latest PMI number, and also a weak ISM PMI, services PMI, that does at least ease some of the concerns about inflation and allow them to act this time around. And the question mark isn't necessarily now whether they're going to cut on Wednesday. It's more what happens from there on in. In terms of the relationship between inflation and treasury yields, what's notable here is that despite the fact that we've seen inflation roll over, the fear and the possibility of a reflation move has kept yields relatively elevated. And certainly Donald Trump's victory and impending move into the White House also raises inflation expectations, because people think that his policies are going to raise prices. Part of that would be tariffs, but also a very much pro-growth strategy. And there's a feeling that he's going to be pro-growth, and he'll do that before he starts worrying about inflation. So higher inflation would likely lift yields in turn. And that's something that's relevant when you look at valuations within the FX markets in particular. You can see by and large, when you cut interest rates, the expectation is that we see yields move towards the downside as well. So, whilst we have seen yields sort of flatlining in the face of downside for interest rates in the US, the view is that by and large, we will see it top out and move towards the downside as interest rates are cut. But when you see multi-month periods where you're seeing shifting expectations, where people think you're going to see 4 or 5 rate cuts and instead it moves to 3 rate cuts, that's when you see the likes of the treasury yields moving towards the upside, as we have seen. And this highlights why it's particularly interesting and notable for FX traders. You can see here the relationship between Eurozone and the US 10-year yield overlaid with euro dollar. And essentially, it's that relationship in terms of treasury yields that really does influence sentiment for those FX pairs, because, of course, you have to trade one against the other. That's why it's very different from assets in the commodity space or assets in the indices space. And so FX markets in particular are really sensitive to those shifts in terms of market expectations for interest rates across 2 different regions. And they're, of course, impacted by things like the inflation gauge that we're going to see on Friday. Now, sort of sticking with that whole euro versus the US dollar, you can see here that the relationship between the Federal Reserve interest rate pathway, which is the light blue at the top, and the ECB, which is this sort of yellow orangey line, we can see a significant difference, right? You can see multiple rate cuts coming into play from the ECB. That hasn't been the case for the Fed. They've had 2, but there's an expectation we're going to see a slower pace of easing going forward. And that's going to be part of why this meeting is particularly notable. It comes alongside the dot plot. It comes alongside expectations for growth and inflation and the like. So what do we think? We're probably going to see higher growth expectations, because things are obviously turning towards the upside. We're also seeing Donald Trump coming in, and the possible measures being implemented by him. But we're also likely to see higher inflation expectations for similar kind of reasons, right? So inflation higher, but growth higher, it really puts less pressure on the Federal Reserve. And that's why people will be closely watching for the dot plot. How many rate cuts are we going to see over the course of 2025? Well, markets had previously thought we were going to see 4. That was what was in the last dot plot in September. That's starting to shift. So we can see here that the move recently has been into that rate cut for December. So it's essentially like a 99% chance that we see a rate cut in December. So that's pretty much a foregone conclusion, 25 basis point cut. You can see in terms of the divergence over the course of the past month, the shift in terms of sentiment around how many rate cuts we're going to see over the course of the next year. This is actually into October of next year. So we'd have a December meeting as well. But the move has been away from the idea that we see a lot of rate cuts and towards the idea that we see a few, right? And certainly when you look at, say, the breakdown here from London Stock Exchange Group on the Icon platform, you can see here that the expectation is, yes, we've got like 97% chance of a rate cut this week, but let's look forward. So when's the next rate cut going to come? There's a coin toss for March. Beyond that, the one time that we see the expectations heavily above 50 is May. So March or May for the first cut, you can quite easily see why there's a strong possibility that we only see 3 rate cuts over the course of 2025. And the possibility of us seeing a shift in terms of the dot plot that would lay out this smaller number of rate cuts, that's where you see the differentials playing out between the likes of the Federal Reserve and the likes of the ECB, because there's a feeling at the moment that the ECB is essentially going to be cutting rates time and time again. Let's go on to euro dollar, and we can see here that from a sort of wider perspective, we've been in this serious downtrend since that peak here in September, and this really tallies up with that rebound that we saw. Remember that Trueflation chart that I showed you? It really tallies up with that. Let me just put this on the full screen. So we're in a downtrend, but we've found a little bit of support. That has come in below this zone here, but at the moment we're finding a bit of support once again, following a rebound back up through that level. Let's just get it drawn on again. I don't want to carry across. So there you go. So we broke through it, we rallied. Now we're seeing a bit of consolidation, holding on to support at 104.482. The key thing here, of course, is that we are seeing some easing inflation expectations around the services sector, and that's where the big problem is, whether it came from the ISM number, whether it's just come from the PMI number that we've seen this week. So we are seeing some easing inflation concerns. So that could help things along. That could help things. And certainly if we saw a lower than expected core PCE figure on Friday, that would also potentially bolster support for euro dollar. But at the same time, when we're looking at this Federal Reserve meeting, you're looking at the possibility of upward revisions for growth, upward revisions for inflation, and then downward revisions in terms of how many rate cuts we get from the dot plot. So it's likely to be a relatively hawkish cut. So you get the cut and it's like, okay, great. But then markets are pricing in like a 97% chance of that anyway. And then the outlook points towards less rate cuts. So you could see strength from the US dollar off the back of that. So potentially around the FOMC meeting, do we potentially see that happening, and we see the US dollar strengthening off the back of that? Or has the recent services data done enough to start to point towards the Federal Reserve needing to do more and they feel more confident? Well, there's likely to be a data dependency within this, and also they are providing part of the data for this meeting. So if you're talking about data dependency and then you say stronger growth, stronger inflation, and then a lower number of rate cuts in the dot plot, that shows you exactly what the data is at the moment. But certainly, we're at a really interesting juncture here because you have that major long-term low. You've also got this recent resurgence, but prices come back down into this 104.6 level. So certainly if we break back below that level and the 104.4, it gives us greater confidence that maybe this sort of rally, this rebound phase is over. To the upside, you're looking at this sort of 106 area that we need to clear out to start looking for a more protracted period. But certainly if we're looking at trends, we're in a very clear downtrend over recent months. So if we break back below this 104.4, then it could be the case that the bears are back in charge. And then wrapping it up, I just wanted to point towards the Dow Jones Industrial Average. Of course, businesses were feeling very confident in the wake of the US election result, and part of that confidence is waning recently. That could be down to in part what's happening in terms of those expectations for rate cuts. But by and large, I'm always positive for US markets. Not always, but by and large, US markets are the ones that outperform. We're seeing this pullback. It flies in the face of the likes of the S&P 500 and Nasdaq, which are reaching record highs. So I don't necessarily think this sell-off is a top in this market and that the other markets continue to rise, but this one's topped out. So I won't be surprised to see the bulls come back into play soon enough. The ascending trend line within this rising channel could be key, but crucially, look out for these Fibonacci levels, the 76.4, which is 43448, and the 61.8, which is 43763. So that's where we are at the moment. So key area of support. We've come into this support zone. The question mark is, what out of this week is going to help this rally? I don't necessarily think there's the Federal Reserve meeting. And in which case, is it going to be the core PC price index figure on Friday? Well, markets are expecting it to rise, and we have a difficult comparative when it comes to the month-on-month compared to last year, which is dropping out. So it's going to be difficult to really see something that's going to cause that major spike for this market. So we could drift a little bit lower. We could consolidate. But, we're in Santa Claus territory, and that Santa rally could start coming into place soon enough. And I think, if they do adjust it to 3 rate cuts for this year, it won't necessarily be a huge surprise because, well, that's what markets are pretty much pricing in as it stands anyway. But certainly a particularly big week, I think, in particular for the US dollar, where you see those sort of relative expectations for monetary policy feeding into those yields. And so if you want to try and do, as I'm doing here, and overlay these different yields and see how things are playing out and how you can see divergence that might potentially signal opportunities for these markets, then you can do exactly that. TradingView is particularly great for that, and comparing say yields of one country to another and then that against the currency pairs really does provide a good way to be able to look at exactly how markets are feeling in terms of the economics, the monetary policy standpoint, and how that's going to influence the FX pairs at the moment. But certainly a big week ahead. I've also provided a breakdown in terms of the UK data, with the Bank of England reporting their latest decision later in the week, and I'll also provide one for the BOJ. I hope this has been useful. Have a great day, guys.